So, good morning or good afternoon, dear ladies and gentlemen. It is my sincere pleasure to welcome you to today's final Volume 3 of our Supply Chain Bites webinar series. I have been asked to provide a short introduction of myself, something I obviously never thought of in the past, so please accept my apologies. My name is Bettina Herzog, and I'm responsible for the regional coordination of our business development in ASEAN. I have been employed with Rödl & Partner for a little more than 4 years now, and being located in beautiful Cologne myself, I enjoy being part of our closely interlinked, multinational, cross-border ASEAN team. And I'm, of course, happy to be your host today. After highlighting the trends and challenges in supply chains in Asia Pacific, sharing an elaborate economic outlook, and exploring Malaysia's potential as alternative supply chain hub in the region, we are now happy to conclude our series with a professional approach to supply chain management in Malaysia, covering all relevant steps and aspects from structuring, contract management, and compliance to transfer pricing and financial reporting. Though we are probably all rather familiar with digital meetings in the meantime, let me quickly guide you through the technical side. In the top right corner of your screen, you will find the control panel. Here you may adjust your audio settings and choose between the computer audio or your headset. Please note that as an attendee, you are muted by default, so whenever you want to take a sip of coffee, feel free to do so. A little further down on the dashboard, you will find the question panel. Please insert all your comments or questions in here for us to take care of later on. You may do so anytime during the session. It will cause no disruption or irritation to the program. We will take down anything coming in and be happy to attend to the questions at the end in our Q&A session. As to the schedule, we will start with structures, contracts and compliance by my valued colleague Christian Swoboda, head of our Malaysia offices. His presentation will be followed by effective management of supply chain with transfer pricing, presented by my dear colleague Priya Selvanathan, head of tax and transfer pricing ASEAN. And we will continue with my equally valued colleague Gabriel Chio, head of Audit Malaysia, who will shed a light on coordination of financial reporting. As always, we will round up our session with a Q&A for you to submit your individual questions. Please note that we will record the webinar and make it available online for you and your colleagues to recap anytime you wish. Looking forward to a most enlightening session. It's now my pleasure to leave the stage to Christian.
Thank you very much, Bettina, for your nice introduction. And dear participants, also very warm welcome from my side. As Bettina has already mentioned, today is about supply chain management. We will look into legal, tax, transfer pricing, and financial reporting considerations when it comes to supply chain management. And I'm extremely glad to be joined today by my two colleagues, Priya, the head of tax and transfer pricing ASEAN, as well as Gabriel, the head of Rödl Audit Malaysia. So let's start with the legal consideration. Next slide, please. Next slide.
I'm sorry, there's a short technical interruption here, but I'm sure we will be back on track in a second. Okay, I think here we go again.
Yeah, okay, thank you. So this is the my short agenda for the legal considerations of supply chain management. I will start off with a short introduction, followed by a slide on how you can utilize free trade agreement networks in your supply chain. We look into how to do business, basically investment versus non-investment modes of doing business. I will briefly also cover commercial agreements, as well as at the end, we talk about the new German Supply Chain Act as a new challenge for compliance in supply chains. Next slide, please. So as an introduction, I wanted to highlight how, from a legal perspective, we would start off with supply chain management. In the first step, we might look into the more broader structure, or let's say framework, where the supply chain is taking place. And within the structure, we would of course look first into the available free trade agreement network. We would also consider, depending on the jurisdiction, whether there are, for instance, available free trade zones or special economic zones available. We also look into tax planning. This is, of course, more than a part PRIA will cover. And finally, we'll also look into investment restrictions, protection of investments or foreign investments, as well as investment incentives. So once we have considered from a legal side this basically framework where we can place our supply chain, we would look into the implementation of the supply chain. There are different modes of doing business. There are a lot of corporate, but also commercial considerations, which we need to think about when we think about the implementation. Finally, we will also cover the topic compliance. Of course, it is a very complex and very large topic, which we can't, of course, cover in all details in today's session. I will focus here on the new German Supply Chain Act, but of course, Priya and Gabriel will also talk about compliance when it comes to tax transfer pricing compliance or the compliance with financial reporting obligations. Let's start with the structure. Next slide, please. Here I would like to highlight how you as a business can benefit actually from the applicable free trade agreement network. And on the left side, I have tried to outline the applicable FTA network in the region. Of course, it's not comprehensive. There are a lot more agreements which I could outline here, but then it becomes even more complex to understand the different FTAs. And I wanted to highlight here how you can do most out of the new regional comprehensive economic partnership agreement. It's not yet in effective, but will become effective very likely very soon. And of course, there are three main elements how you as a business can benefit from the preferential rules of RCEP. So first, we look into trade in goods. So the essential question here is a certain good qualifying to benefit from the preferential rules of RCEP? Basically, this falls under the chapter of rules of origin. And this question is quite easy when it comes to goods which are wholly obtained or produced in one of the member states of RCEP. RCEP is also providing cumulative rules which will allow a better regional integration of supply chain. And for goods who are not fully obtained or produced in one of the country, there are special regional value content rules applying. So basically, we would need then to calculate to what extent rules of origin are applying to a certain good. The next step would be trade in services. So the different member states of RCEP applied here a different approach. So some follow a positive list, some a negative list. In essence, that would mean they would define what services they would liberalize in their jurisdiction in a positive way or a negative way. There are also denial of benefit rules. Basically, it says if a service provider is not registered in one of the RCEP member states, there could be a denial of the benefit of these trade and service liberalization rules. Finally, there's also the investment protection chapter of RCEP. Here it's important to say that if a legal person which is owned or controlled overseas, so not within one of the RCEP member states, and which has no substantial business activity in the particular member state, this company would not benefit from the investment protection chapter. So basically that means if you have a mere holding company, say a German holding in one of the RCEP member states without any particular business activities, you would not benefit from the investment protection. And it's important to see that all those FTA agreements, they overlap. So in order to make most out of it, it depends to look into different chapters and to compare them. And this can be a quite extensive exercise. Next, I would, next slide, please, sorry. Yeah, in this slide, I would try to outline different modes of doing business. So in essence, there are two different modes of doing business. One is the non-investment mode, which is basically the contractual mode of organizing your supply chain. The other one is the more investment mode, or basically more equity mode, where the principal owns and controls the supply chain. Of course, that is not a usual picture. Most principals would not control the entire supply chain, but parts of it. And the picture in real life is, of course, much more complex. Think about joint venture arrangements or regional or large-scale cooperation agreements, or also quality assurance arrangements between elements or members or parties of the supply chain. Next slide, please. And those different types of doing business have, of course, benefits or like advantages and disadvantages. It basically comes down to the level of control, the level of flexibility, different costs or risks applying to each of these modes, and there are a lot of different aspects which need to be considered to find the right mode of doing business within the supply chain, the framework. Next slide, please. On this slide, I would like to highlight certain points of the commercial agreement. So basically, once we have considered how we want to do business, so this chapter would be, how can this be done in detail? So in essence, we can compare, divide the topic commercial agreements into two parts. One is the third-party commercial agreement, and the other one is the intercompany agreements, which play a bigger role in Priya's presentation. For the third-party commercial agreements, it is important to consider that in a supply chain, there are also three, let's say, chains which you need to consider in those commercial agreements. One is the chain of payments, another one is the chain of legal title, and the third one is the chain of liability, product liability in a supply chain. Let's start with the payment terms, or the chain of payment. It is important also when it comes to cash flow within a supply chain, or to avoid additional funding costs, that the payment terms are aligned. Think about, let's say you have a supplier, a manufacturer, and a wholesaler. When payment terms are not aligned upstream of the of your supply chain, there could be an issue with cash flow. So they should be aligned when it comes, for instance, to the payment date. So when is a payment due? In 14 days or in 30 days? It should be aligned in order to avoid certain cash flow issues within the supply chain. Another big topic is, of course, the chain of title. When is the title transferred? For instance, are there retention of title clauses within the supply chain, which basically means the title is only transferred once payment has been made? And also, what happened to a title when goods are, let's say, processed, mixed, or combined to each other? What happened then to the title? This should be addressed in the agreements in order to avoid legal uncertainty when it comes to ownership and legal title. The last chain I would like to highlight is the chain of product liability. Think about who is liable for a damaged product, or in particular, who is liable for indirect damages caused maybe by a product. So all those issues should be addressed within the agreement. And of course, when you address those in an agreement, it's important to also think about the applicable law, because it might not only be contractual law applying, but also statutory law. So it's really relevant to choose the right law for your supply chain, to consider what is the best law applicable, and also consider how you want to resolve disputes along your supply chain. This is it for third-party agreements. Another issue could be intercompany agreements. Again, like as said before, Priya will look from a transfer pricing point of view into those agreements. From a legal point of view, it's really important to draft those agreements in a very clear language and with a very clear commercial background, because intercompany agreements are likely to be disclosed to third parties, particularly tax authorities, and it's important to them to fully understand the commercial intention and background. Again, Priya will talk more about this. Next slide, please. In my last slide, I would like to highlight changes coming likely soon with the German Supply Chain Act. Currently, the German legislator is working on this Supply Chain Act. The idea is that companies headquartered in Germany with a certain threshold of employees need to put in place certain due diligence or comply with certain due diligence requirements when it comes to human rights and environmental protection along their supply chain. This does not only apply to them, to their own business activities, but also to direct suppliers and to some extent even to indirect suppliers, of course. When I said to some extent, an extent where knowledge is there, and because of course there's lesser control for those indirect suppliers. Again, the law has not been passed yet, so we need to see to what extent this law will be put in place, when and how it applies, and companies, once this law has passed, need to consider how they want to put in place management and control mechanisms to ensure compliance with this new Supply Chain Act. That's already from my side for the legal considerations. Thank you very much for your attention, and I would pass on now to Priya.
Thank you, Christian. So good morning or good afternoon, depending on where you are. And so my part here, I'll be talking about the supply chain and transfer pricing and how you can manage this effectively. Can we go to the next slide, please? Yeah, so as we know, so a company's or group's effectiveness and competitiveness is largely influenced by its supply chain. So if you have an efficient and an agile supply chain, it will allow you to effectively optimize your group's effective tax rate, while at the same time also helping you manage your tax risks. And especially during the pandemic, we're seeing that companies are starting to see more of an importance of having a more agile supply chain. And one of the key things to look at when trying to optimize your supply chain is, of course, transfer pricing. Because throughout your value chain, you have transactions or relations between your related parties, which will help you then manage your supply chain and, in essence, also, in effect, manage your group's effective tax rate as well. So while transfer pricing is generally seen as a hot topic, as an issue that companies need to look at, because this is an area that the tax authorities are looking at, it also does present an opportunity for groups to optimize their overall tax structure. And of course, and in addition to transfer pricing, there are also other tax areas that come into play as well when looking at optimizing your supply chains. And this includes things like your corporate income tax, withholding taxes, your indirect taxes like your GST, VAT, customs duties, and even tariffs. So one way to optimize your supply chain is, of course, to have certain functions in certain jurisdictions to take advantage of if there's any potential tax arbitrage. So one jurisdiction which has low tax, one jurisdiction with high tax, that's where you can pay and get some tax arbitrage. Another way would be to, of course, take advantage of there are any free trade agreements or if there are any tax incentives. In Malaysia especially, there are a lot of tax incentives covering different industries, different sectors, so like manufacturing, services. And of course, now there are incentives for Industry 4.0, regional headquarters as well. So all in all, in a nutshell, when you're looking at optimizing your supply chain, it's not enough, and it could also be very risky to just look at it from a tax and transfer pricing angle. So you should always consider looking at optimizing your supply chain from looking at the trade and business and commercial justifications as well. Next slide, please. So looking at this slide, you'll see a very simplistic illustration of how, if you have an optimized supply chain model, it can help to improve the tax efficiency of the group. So on the left-hand side, we can see the unoptimized model. And we see that on this side, the brand owner or the distributor bears the majority of the risk within the group, and therefore is required to earn a higher return. As the brand owner or distributor is in a higher tax jurisdiction, this would result in a higher effective tax rate for the group. And then now let's look on the right-hand side where we have the optimized model. In this case here, we have where the principal or the brand owner is the party that bears the higher risk, and it's located in a lower tax jurisdiction. The role of the distributor here is that of a limited risk distributor, and so it should by right be earning a lower and more routine return. And it is also located in a higher tax jurisdiction. Same applies for the manufacturer as well. It's a contract manufacturer and should be earning a lower and routine return. So in this very simplified illustration here, we can see that by moving the entities with lower functional characterization and lower risk to a higher tax jurisdiction and the higher risk entity to a lower tax jurisdiction, you can effectively lower the group's effective tax rate. Now, of course, this is a very simplistic view of things, and in reality, there are actually many other considerations to be taken into account here. One of the main concerns for groups would be the issue of the IP or the intellectual property or the brand name or any trademarks and patents you may have. So in this example, for example, is the brand owner merely the IP owner, or is it also developing the IP? These are questions you would need to ask yourself. Does the principal in this case have substance in the jurisdiction, and can it be seen as actively carrying out a business? Or if it's merely an IP holding company, it then may be hard to prove that it actually has substance. And from a tax perspective, then it could be difficult to justify to the tax authorities that it in fact has substance and it should be earning a higher return. So if it is merely just an IP owner, it doesn't develop any of the IP, there are no people, there are no actual assets there, it may in fact be difficult and it may not be sufficient to attract the totality of the IP value and therefore earn the higher profits. So the discussion on supply chain management effectively and within a group always usually centers around transfer pricing. When tax authorities look into related party transactions, they are interested in effectively the attribution of income and profits among related companies, and then looking at supply chains that that are across borders, tax authorities, of course, looking at protecting their own interests. They want to collect tax revenue in the country. So that is where the whole issue of transfer pricing becomes a fairly heated topic. So the attribution of income should reflect the nature of the functions performed. And this is an accepted transfer pricing principle. It should also reflect the level of the risk undertaken as well as the assets used. Which is why in this example on the slide, I speak about the functions and the risks. Because this is what will essentially determine the value being derived by a company and whether the returns, that is the income, and ultimately the profits being derived is commensurate with the economic value creation. And if you are considering to move or realign certain functions, assets, and risks, you would then need to also consider what are the transfer pricing rules, regulations, and especially the practices in the jurisdictions, and especially within the ASEAN region. Sometimes the practices and what is in what is legislated may be different. So it's important to really understand what are the practices in the country, what is accepted by the tax authorities. And you need to ensure that the profits are aligned then also again with the functions and the assets and the risks. So going back to my earlier example of the principal being the IP owner or the IP developer, it's an important distinction to make, because it may be likely in this case that the principal is merely the IP owner, and in such a case it may not be right to call this principal the high risk entity that should be earning the higher return. Also, if it did not bear the risk to develop the IP, it may also not have the assets for developing the IP, so it may not be right for this entity to be earning the higher return. And another point I'd like to make is the current business environment has brought forth a lot of disruption. The issues that are surrounding supply chain had already started happening and started to gain prominence before the pandemic even happened. And the pandemic merely exacerbated these issues. It forced certain companies, and especially larger groups, to really take a hard look at their supply chains and to see how they could remain agile in an increasingly disruptive business and tax environment. So you need to look at evaluating, again, your functional profile and your levels of profit for all parts of the supply chain, and analyze which entity is bearing the majority of your functions and risks. So make the corresponding changes to the levels of profit in the limited risk entities. So for example, your limited risk distributors and contract manufacturers, if there is a change in the management functions, these should also be looked into as well, whether these are temporary or whether these started off as temporary and will change into more of a permanent structural change. These need to be looked into as well. So if any changes are made to intercompany transactions, your intercompany agreements should also be revised to reflect these changes. And of course, we can't forget about the other tax considerations. So what is the impact that changing or shifting certain functions would have on your direct taxes, so your corporate tax rates, and your indirect taxes like your GST, VAT, and things like that. So, and this should be analyzed in totality with the entire structure, because a change in the transfer pricing model will have an impact on the overall tax structure of the group. And one of the main issues that businesses faced during the height of the pandemic was that the supply chain disruption impacted their delivery channels. So it forced some companies to do a quick pivot on their delivery channels, and some even had to change into an omni-channel business model. So when considering your supply chains going forward, it's important for you to look at avenues that will help you have a more agile delivery model to allow you to respond quickly to these changes in demand and any potential future trade barriers. Understanding these tax implications in advance will help you then keep your business informed of how and where the economic value is created, and that is who bears the risk and who earns the return, and as well as the corresponding tax costs. So it's important to look into, try to look into as much of the potential issues in advance before the issue actually comes up. So another issue would be, of course, surrounding the digital adoption, something that we simply can't ignore anymore, and the tax implications surrounding that. So digital tax is increasingly becoming a hot topic with the tax authorities and also with the OECD. So a lot of countries are starting to implement a digital tax. In Malaysia, for example, we have also introduced a form of digital tax, which is the service tax on digital services. So it's necessary then to understand the broad scope of the impact of digital tax and how it impacts your supply chain. And when looking at all these different aspects, one of the main things to consider, and I briefly touched on this earlier, is substance. So depending on the jurisdiction, there may be different tests on the functionality and risk to determine how substance is proven. So going back to the earlier example of the IP, it may, again, like I said, not be enough to just merely have ownership of the IP, but you might also need to have the management and the development of the IP for you to then be regarded as a high risk entity. So the people driving the IP creation, the maintenance and the enhancements need to be in the same jurisdiction as the ownership. Otherwise, the IP ownership alone should, by right, earn a lower return. And of course, as you do go through all this and as you make all these changes, with any of these changes, the most important thing to do is to make sure these are documented and to make sure they're documented properly. So the documentation is utmost importance. You need to ensure that your intercompany agreements reflect all these changes, a one-page document, one-page agreements are no longer sufficient in this day and age anymore. Your transfer pricing models and then your transfer pricing documentation should also be updated to reflect any of these changes as well. So in a nutshell, while the current business environment does require you to remain agile for you to be efficient in the market, while also taking into account the challenges from the tax environment, these changes drive your business business strategy. So you also can't forget the impact of tax and transfer pricing in managing the supply chain. So the tax and transfer pricing implications should never actually be the last thought. It should always come together with the commercial considerations as well. So because when you manage all of this together with your tax, with having tax in mind as well, then you can also not just manage your group's effective tax rate, but also help to mitigate certain tax risks as well. So that's all from my side, and I will pass it on to Gabriel.
Hi, thank you, Priya. Good afternoon, everybody. I'm sure you've been filled with a lot of ideas about how to basically structure your contracts, your legal obligations in the supply chain. And further, you were enlightened by Priya on the tax issue and tax implications of all those impact when you create a supply during your supply chain. Now, what I'm going to talk to you about is literally about financial reporting and coordination of your reporting deadlines and meeting your reporting obligations. Okay, in Malaysia, next slide, please. In Malaysia, the agenda for this afternoon, my brief discussion, it will be on financial reporting in Malaysia, a comparison of German GAAP and Malaysian financial reporting standards, the mandatory requirements of audit for most of the entities in Malaysia, and finally, how do you overcome the difficulty of meeting deadlines, which is very crucial for your reporting for your supply chain. Next. Okay, in Malaysia, our reporting are governed by Malaysian Accounting Standards Board, or MASB, which was established under the Financial Reporting Act 1997. Company registered in Malaysia are required to prepare statutory financial statements in accordance with the approved accounting standards issued by MASB. If you are a foreign company that is listed in Malaysian Stock Exchange, you may prepare financial statements in accordance with certain international recognized accounting standards. In Malaysia, it's very likely to be IFRS. Next. Okay, talking about approved accounting standards in Malaysia. Basically, there are three types of standards being approved in Malaysia. The first one, of course, is a defunct defunct private entity reporting standard, or PERS, which was initially introduced in Malaysia for private entity. Basically, when Malaysia talks about private entity, usually that means there's no listing requirement or obligation that are required under the central bank or insurance company. This PERS is replaced by Malaysian financial reporting and also by Malaysian private entities reporting standards, that's MPERS. It replaces PERS on 1st of January 2016. Generally, this PERS is based on IFRS or SME, so with a slight minor variation, and is generally a preferred choice for German entity in Malaysia because it's closer to German GAAP. I shall illustrate the differences between the other standards and German GAAP shortly in the later slides. Okay, the last and the final standards is, of course, the Malaysian Financial Reporting Standards, MFRS. MFRS are basically IFRS compliant standards. So basically, if you adopt MFRS, you're basically IFRS compliant. Okay, next slide, please. Okay, the only exception between MFRS and IFRS is actually illustrated here in this slide. Under MFRS 10 or IFRS 10, the difference is mainly this para MY 4.1 that is illustrated here. In this case, notwithstanding paragraph 4A, which is, and unless paragraph 4B applies, the ultimate Malaysian parent entity shall present consolidated financial statements that consolidate its investments in subsidiaries in accordance with these standards. In summary, all these words means that if you have a subsidiary in Malaysia and they have some subsidiaries there, notwithstanding the fact that in normal IFRS, they don't need to consolidate because they probably have a holding company overseas. If you follow IFRS, you don't need to consolidate. But if you follow MFRS, if the Malaysian entity has subsidiaries, you need to consolidate your subsidiary figures with the Malaysian entity. So in that situation, usually when we actually get a Malaysian entity, we need to work with the subsidiary companies overseas. It could be in Malaysia, it could be in Philippines, it could be in Singapore, it could be in Indonesia, or even China. Next slide, please. Okay, we have talked about the differences and the reporting framework. Now let's look at the differences between Malaysian Financial Reporting Standards Framework and German GAAP or HGB. I'm taking German GAAP as an example just to illustrate to you that actually the accounting standards or the general accepted accounting principles in your country may differ from MFRS by significant bit over here. So let's look at MFRS. MFRS is basically based on IFRS, which is an Anglo-Saxon accounting regime, as opposed to German GAAP, which is a typical example of continental European set of accounting rules. So German GAAP is based on European accounting rules, but IFRS is based on Anglo-Saxon. In MFRS, it tends to be investor-oriented objective. Basically, we look at investors' approach and perception on the requirements for the reporting. But in German GAAP, it's still very traditional. It's still very much a creditor protection principle. Basically, they always talk about being conservative, make sure that accounts are not overly stated, the value are not liberal, so that there's a fall-through mechanism if the company value start deteriorate. MFRS, like any IFRS, is always about fair value accounting. There's a tendency to go towards fair value for almost everything in the balance sheet. And again, in German GAAP, you find again conservatism reigns. Like what I said earlier on, because of creditor protection, there tend to be a lot of prudence, a lot of imparity. IFRS will probably find a bit more information for user who are investing in a company wanting to know what exactly are the fair value of the assets. And of course, it fluctuates from time to time. IFRS does not get itself linked to tax law. As a result, there is a lot of requirements to carry out reconciliation between MFRS and the relevant tax law that is in Malaysia or anywhere else. As opposed to that, German GAAP tends to be more of dividend distribution and taxation. So it tends to be more skewed towards harmonizing it with taxation rules. In MFRS, accrual principle is decisive, whilst in German GAAP, principle of realization and prudent profit calculation are decisive. There is a considerably amplified disclosure and information obligations in MFRS, but in German GAAP, you don't get all these little lengthy notes that you see in MFRS. Okay, so next slide, please. Okay, let's talk about, now that we have looked at the requirements, let's look at the differences between the financial framework. Let's look at the audit requirements in Malaysia. Malaysia is still pretty much conservative. That requires audit mandatory audit for most of the entity that is in Malaysia. So all companies incorporated in Malaysia must have their accounts audited by an approved auditor as mandated by the Companies Act, with the exemption given by the Companies Commission of Malaysia. However, audited accounts may not need to be filed if you meet the exempt private companies. These exempt private companies are basically companies having no more than 20 shareholders, they call it members, and none of them are corporate shareholders. So in essence, you're very unlikely to fulfill these exempt private companies requirements to be able to avoid the filing of your audited accounts. And of course, there's limited exemption for audit, as I mentioned to you earlier on. They are mainly limited to dormant companies. Let's look at it in the following slide. Next slide, please. Okay, audit exemptions. These are the criteria that have been provided under the Companies Commission of Malaysia. The first one is easy. If you're dormant, it means business have no accounting transactions occurring and its operation have not altered at all. And of course, these are pretty easy, straightforward obligations. Now, there's a next exemption, which is on a zero revenue companies. In this case, the revenue of these companies are zero, not only for the current year, but also the past 2 financial years. In addition, there is also another requirement of having your assets not more than 300,000 in the current and the previous 2 financial years. Lastly, you can still meet the exemption if you have very limited revenue. However, the threshold is still very stringent. The requirement is that revenue does not exceed Malaysian ringgit 100,000, probably about 20,000 euros, during the financial year as well as in the previous 2 financial years. Again, the 300,000 asset value kicks in for the current and also the previous 2 years. So hence, these are the 3 requirements for audit exemption. Now let's go to the next slides, please. Okay, even though you might be exempted from audit by the Companies Commission rules just now, you still have to bear in mind that it doesn't automatically free you from the obligations, because there is still a requirement to file an audited accounts under the tax regime. Because usually your tax computation are based on audited accounts, and our inland revenue requires tax to be the accounts to be audited before you, and the tax computation are based on the audited accounts before you file the tax return. Next, please. Okay, having talked about compliance in Malaysia, about the framework, the bodies that regulate it, and also the different type framework, let's look at one of the key crucial points. Having established a supply chain in Malaysia, measurement of your profit depends on good coordination. And to ensure efficient and timely reporting of a German group level, main coordination key point is to ensure clear instructions are given to group auditors and the auditors of subsidiaries on the timeline and milestones expected. Obviously, clear instructions, timeline are important. In addition to that, the reporting packages and other deliverables expected to be received from the management and auditors of subsidiaries also need to be highlighted clearly. Having last-minute requirements and communication on reporting package always throws the reporting deadline to chaos. So, proper planning and due diligence to get communication, to get the auditors and also the subsidiary auditors up to date with the requirements is definitely crucial. To ensure that management accounts are prepared and ready for audit, in some cases, management accounts are based on German GAAP. As a result, steps are required to ensure that the management accounts are ready for audit, i.e. conversion from German GAAP to Malaysian approved accounting standards. This is crucial. Sometimes you might have a group framework that reports to Germany on a regular basis on a German GAAP, or any other reporting framework that you might have if you're not from German but from other countries. You have to be aware that the accounts need to be converted into Malaysian financial reporting standards so that you can meet the statutory requirements. Otherwise, you might get affected in release of the report and clearing of the report to meet the timeline. To ensure mutual understanding between preparers and accounts and auditors on expected HP2 adjustment to be made. Communication of what is the adjustments to reconcile to the holding company's accounting standards framework or gap needs to be communicated early so that there's no unexpected situation where the subsidiary auditor suddenly finds that they cannot explain why there was an entry, and to confirm those takes time and cause further delay in the reporting timeline. Next. Okay, in short, to ensure that all HB2, basically all these statutory audit adjustments are properly documented and understood by local management. In most cases, HB2 adjustments are made by group accountants at group level. Local management are sometimes unable to explain these adjustments to the local auditors, which results in dispute or time spent to get clarification from group management. So as I mentioned earlier on, all these things need to be communicated earlier on the adjustments to reconcile to the holding company, so that to avoid delay in reporting. With that, I think next slide. With that, thank you very much, and I would like to hand over the floor to Bettina.
Thank you very much, Gabriel. Thank you very much, Christian and Priya, for highlighting the comprehensive and complex considerations that have to be kept inside upon managing your supply chain successfully and sustainably in Malaysia and beyond. So we are now glad to attend to your questions, and I would like to start with the first one. We are a typical SME company. Is our understanding correct that the German Supply Chain Act would not apply to us?
Well, I assume that's for my part, from the legal part.
Sounds quite legal, yes.
Yes, as mentioned, so at least at the current level, the German Supply Chain Act would apply to companies which are headquartered in Germany and with a global workforce of, I think by 2023, 3,000 employees, and by 2024, just to 1,000 employees. So let's say your company has 1,000 employees. By 2024, you would need to comply with the German Supply Chain Act. So when you are a typical SME, we need to consider what is actually an SME. And of course, by definition, can be also very large. What is important in with this regards, there is also a European legislation on the way with regards to supply chain due diligence requirements for companies with different thresholds. So under the European rules, they would exclude SMEs, but the SME definition under European rules is 250 employees. So you can see that different thresholds are applying. So it's not so clear, to what extent every SME, let's say, is excluded from those rules. But we need to see on what extent the German or the European rules are actually implemented and when they are applying.
Thank you very much. Does anybody else want to add anything to that? Which sounded like a legal question. So this one sounds more like a text question. How do I deal with temporary changes in my supply chain due to the pandemic? For example, a change in an intercompany supplier.
Right, so yes, so that is a text question. So if there's been any change in your supply chain due to the pandemic, for example, one of the most important things that you need to do, of course, is to document these changes. So how it has affected maybe the transfer pricing model, maybe the the benchmarking analysis may need to be redone. So all the change in the assumptions that that no longer applies under a normal business situation would need to be documented. There is some OECD guidance on this, and a reliance can be put on those OECD guidance. But of course, it comes back to, you need to relook into your functions, the assets, the risks. Maybe we need to redo a benchmarking study. But most importantly, you need to document all these changes. So in the case that there's an audit a few years down the road, these can all be defended.
Thank you very much, Priya. This one seems to be a little more general. Are there any investment restrictions in place in Malaysia which we as a company would need to consider?
Well, in general, I think for Malaysia, we can say that Malaysia has a very investment-friendly environment. The recent World Bank, I think it's an Ease of Business ranking, ranked Malaysia as on number 12. So it's quite a liberal country when it comes to doing business. However, there are, at least in some sectors, investment restrictions in place. And these restrictions are normally implemented by the requirement of having a local shareholder or certain local requirements to management or capital requirements. But again, like these are only, this is applying only to very few sectors.
Thank you. Here's one more. What are some of the tax risks to consider when looking at reorganizing my supply chain? This one seems to go to you, Priya, once more.
Okay, right. So I think I covered that quite in depth in my presentation earlier. So one of the most important things you need to look at is the reallocation of the profits. So how are the profits being reallocated, and is it commensurate with the functions, the assets, and the risk? So comes back to again the issue of substance versus form here, where what you do has what is documented needs to actually be what you do, and vice versa as well. So the issue of substance versus form is very important. That's becoming more of an issue with the authorities, which is why, as I mentioned in my presentation earlier as well, no longer sufficient to just have a very generic or general one-page document to explain your intercompany transactions. And the documentation, again, come back to the same point of it becomes very, very important to have the proper documentation. Yeah.
So no room for copy and paste, obviously.
No room for copy and paste.
So as far as I can see, this is it for our question panel. So I'd first of all like to thank all of my colleagues for sharing their professional insight into one of the most complex issues, I'd say, in organizing your cross-border business. And thank you everybody for attending and participating in today's session. Should there any questions be left unattended or come up later, please do not hesitate to come back to us. We will be happy to answer all questions coming up. As always, we have recorded the session and we'll make it available online later on for you to recap anytime you wish at your personal convenience. And it will also be my pleasure to share the slides with you upon request. Stay safe, take care, and I hope to see you soon next time. Bye-bye.
Bye-bye.
Bye.
Thank you.
Bye. Thank you.